Okay, so in chapter 2, we're going to talk about what they call the building blocks of managerial accounting. I also like to think of this as foundational type of materials. Everything in this chapter will essentially carry over into the rest of the semester because you're going to be learning new terminology, and the terminology will then allow you to be able to read problems and work problems later on. So this is a very important chapter, which is why we are going to be spending 2 weeks on this to make sure you have a firm grasp on the basics and the foundation of managerial accounting. Okay, so in the first objective, we're going to talk about the differences among what they call service types of industries and companies, merchandising companies, and manufacturing companies. Now, in your financial accounting course, at least here on the St. Louis Community College campus in my courses, we tend to focus mostly on merchandising, but you're going to find that in managerial accounting, you can focus on all three. And specifically, I like to focus a lot on the concept of manufacturing. Not that it's exclusive to this class, but I tend to use that a little bit more than the other types as I attempt to teach you the concepts of managerial accounting. Okay, so again, the three types of industries are what we call a service industry. That's the first one, merchandisers, and then manufacturing. And of course, your service types of companies, I mean, this is an accounting class you can think of as kind of like your CPA firms, a doctor's office, and that kind of stuff. A merchandiser, basically Walmart, Target, they sell inventory. That's basically all they do. A manufacturer builds inventory. So a manufacturer could be like Toyota, an automobile manufacturer, Caterpillar, candy bar companies, you name it. So basically, you have service, which provides services, you have merchandisers, which sell inventory, and you have manufacturers that essentially make the inventory, and they essentially then sell to the merchandisers. So again, just to walk you through some more examples, again, service companies, again, their goal is to provide services only. They typically don't have a lot of inventory other than what they would possibly use in the office. So again, like I said, some examples could be advertising. I think I said CPA firms earlier, doctors' offices, law firms, definitely a law firm. That's essentially what they do, insurance companies and so forth. That's what they do. They provide services. And of course, you've got your merchandisers where they buy from suppliers and wholesalers. And so, again, Walmart, everybody's familiar with Walmart, Best Buy. We've got these online retailers now like Amazon and so forth. Some of you may have actually bought in your textbook from Amazon or possibly a Chegg type of source. But again, we're talking about the merchandisers. This is primarily what you most likely would have learned from in your financial accounting course. And now the manufacturers, again, what they do is they take a raw material and they convert it into a finished product. So again, that's just what they do. They produce. So again, I had given you some earlier examples of automobile manufacturers, but here's some more. You've got Procter & Gamble, General Mills. You can think of what they make. A lot of cereal, computer, manufacturers, Dell, Apple, Macintosh, that kind of stuff. Now, the one thing that's going to be interesting, we'll talk about later, is that when you make goods, there's actually going to be what I call a cost flow in terms of when you make the inventory. And these cost flows are going to wind up in three separate inventory accounts along the way. And that's going to be a little bit different than the merchandiser or the service company. Now, these three inventory accounts, like we said, a manufacturer converts the raw materials into a finished product. So typically, I like to think of these as steps along the way. So you start off with raw materials. From raw materials, it goes to a place where as you're working on it, you haven't finished it yet, it's going to be called work in process. For short, you're going to see me write this out a lot. I like to call it WIP. And then once it passes through the WIP stage, then the third stage is you're finished. And the interesting thing is these are all considered inventory accounts. And the reason that is important is all about presentation. Remember, inventory goes on the balance sheet. And again, why that's important is that a company incurs a lot of cost when they're producing inventory. And so the question is all about timing. When do these costs get expensed? And remember, it's that cost of goods sold. This is that accrual accounting concept. You expense inventory when you sell it, not when you make it. And so you can think of, since all these costs end up on the balance sheet, it's actually deferred. You're actually deferring your expenses until you sell them. It's all about that matching principle, time periodicity assumptions and stuff, the stuff you learn in financial accounting. So that's one of the things we're going to work on in this chapter, is identifying these raw materials and work in process and finished goods accounts, and understanding the cost flow aspect of these, because it does matter at the end of the day when you get to your financial statements. You still need to know what goes on the balance sheet versus what goes on the income statement. So again, just to recap, remember you have 3 inventory accounts here with merchandise, with manufacturing. These are all inventory, they're on the balance sheet. It stays in the balance sheet until essentially once it gets to finished goods, which is basically sitting in the warehouse, it stays there. You have all these costs built up in the finished goods. It stays in the balance sheet until you do what with it? Until you sell it. And when you sell it, that's when it becomes what you call COGS, which I refer to as cost of goods sold. Okay, the next objective is to talk about what we call direct cost versus indirect cost. And this is important because you have to be able to know how to trace cost to a cost object. If you're talking about an automobile, obviously, in terms of tracing costs, that does determine the type of accounting you're probably going to implement. We'll get into that a little bit later, but there are various costing methods that companies use, and lots of it really does depend on what type of product you're making and what the type of costs are involved. So in the next couple slides, we'll talk about what you call direct cost and indirect cost. Okay, so when we talk about a cost object, again, it's something that you're trying to measure the cost of. So it could be a car, an automobile. And within that, again, you want to be able to figure out, of course, what is direct versus what is indirect. And a lot of it later on is going to involve decision making, because lots of times when you are in business, you want to be able to predict cost, to be able to make decisions about future cost. And in order to do that, you have to understand what's direct and what is indirect. So if you look at this example, it says classify each of the following costs as either a direct cost or as an indirect cost, assuming that the cost object is, in this case, is going to be a department, juniors department area, which is basically clothing, accessories for teenage and young women. And this is going to be at the Kohl's department store. Again, Kohl's is a chain, it's a merchandiser. And so they give us letters A through L, all these different types of cost. Remember, the cost object is this specific department, and we're going to walk you through each of these in the next couple slides in terms of talking about why these are direct or why these are indirect. So in this example, so again, the first one was depreciation on a building. Guys, depreciation is always going to be considered indirect. The idea of tracing the depreciation for a 20,000 square foot building to maybe 100 square feet of an office or a little department like this, it's not that you can't do it, it's just that you can't do it easily and conveniently. So to try to distinguish between just the words direct and indirect, think of direct as easily traced to the product, and think of indirect as not easily traced. So items such as depreciation, property taxes, insurance, stuff like that, we're always going to say indirect. Okay. Now, so the next one, then, the cost of costume jewelry of the mannequins. Remember, that should be something that's fairly easy to trace to a product because these mannequins are in their area. So we're going to say that's going to be direct. Cost of bags used to package customer purchases at the main registers. Remember, this might be kind of hard because you could use a lot of different bags, depending on if you ever walk into a grocery store. Think of the little plastic bags they put your groceries in and your food in, and that can be quite extensive, and it does vary a lot. So sometimes that's not always easy to trace easily. So we would most likely would say that's indirect. Now, the store manager's salary, we're going to call that indirect, because remember, the store manager, this is for the entire store, not just for the junior section. So to actually figure out how much of this salary goes to the junior section, you'd have to do some calculations and do some averaging and so forth. So it's not that you can't do it, it's just not something that you do right away and very easily. So you'd say that's more likely indirect. Same thing with security. Security, They monitor the whole store, not just one little area. So because of that, you'd say indirect. It's for the same reasons as the store manager salary. Now, the manager just of this particular department, this is all this person does. The junior manager's department, all of his pay goes to this particular department. So that would be a direct cost. Okay. So notice the difference between just the store manager's salary and just the manager of this particular department, because this person is only being paid within this department. All of their costs can basically be associated with this department. That's pretty easy to trace. So we're going to call that a direct cost. The juniors department sales clerks, same thing, same reasoning. This is all they do. They work in that area only. All of their salary goes to that department, so it's got to be pretty easy to trace. That's direct. Same thing with the next one. It says cost of the clothing. This is only the clothing in the junior area, so everything there is pretty easy. That's just a direct cost. And then finally, the last one, think of it, hangers. You've always seen these hangers in these department stores. They display the clothing. Companies buy these things by the thousands. And so to be able to trace every single hanger to this particular department is not something that would be quite easy to do. So you therefore would say indirect. All right, kind of wrapping this up. Again, electricity for the whole building, not just for the department. So you have to do some allocating. So again, that would be most likely indirect. Cost of radio advertising for the entire store, because it's for the entire store, not just for that one department, you'd say indirect. And finally, juniors, clothes, buyers, and salaries. Notice it says these buyers buy for all of the juniors departments of Kohl's stores. So again, this isn't just for this one particular location. This is for all locations, across the country. And so because of that, you most likely would say indirect. If they bought only for this particular store, then you'd say direct. All right, so the next big thing is to talk about what they call inventorial product cost and period cost. So we'll talk about how do you distinguish between what they call a product cost and a period cost. Again, this is big stuff. This stuff will carry over, again, like I said earlier, for the entire semester. So again, when we're talking about product cost, what you need to worry about, at least at this point, is that a product cost is something that's basically inventoriable. And we're not really going to get into the internal versus external costs, again, because we do a lot of internal stuff. But the basic idea, I think, that's going to help you read problems is think of your product cost as anything that could be inventoriable. Now, you're going to see this in the next couple slides. But again, I like to introduce this from a manufacturing type of perspective. And so I always like to tell my students, like when I'm doing it in class, is I always like to say there are actually three types of product cost whenever you're looking at, again, this is from manufacturing. And these product costs would be, I'm going to label them right here. Number one, you're going to say are direct materials. That's going to be the first one you're going to see. The second one, it's going to be called direct labor. And the third one is what they call manufacturing, I'm again writing this out, manufacturing overhead. And the way we're going to distinguish among these three types of, quote, product costs is look at the word, again, direct material, direct labor, and then overhead. And I mentioned direct versus indirect in the previous slides. Remember, think of direct as easily traced to the cost object versus indirect, which is not. So an easy way to distinguish among these three types of product costs later on is think of it. A direct material, again, easily traced. Direct labor, easily traced. So therefore, where do you think that's going to leave overhead? Overhead is going to be all of your indirect materials and labor, essentially. And so because it's indirect, it's not going to be easily traced. So that's how you kind of remember overhead. Manufacturing overhead is all the indirect cost to the product versus the two that are direct, that are easily traced. We call those direct materials and direct labor. Now, you'll notice on this particular slide, they're showing you inventoriable, again, product cost and period cost. Now, let me mention before I, again, talk about this slide, remember, product cost, because we're using the phrase inventoriable, think of period cost as basically these are costs that you expense as you incur them. So they're expense as they are incurred. All right, so in other words, they go right to the income statement. I'm going to write this up here because that's where expenses go. Remember, product costs, which are inventoriable, they are going to be on the balance sheet right away, not on the income statement. And that's important in terms of when do you account for the cost and when do the costs get expensed. So period costs get expensed right away. Inventoriable product costs are basically deferred as inventory on the balance sheet. They do not go to the income statement. Remember, they go to the income statement when you sell them. That's when they become the cost of goods sold. Now, as you look at this particular slide, notice it says you've got total cost here, and they distinguish here between inventoriable product and then your period. So kind of study these examples. Look at the period cost. You have R&D, design, marketing, distribution, customer service. You know, I always like to think of period costs. Think of it, a lot of it, as your administrative cost. This could be your CEO salaries as well, advertising. This is your marketing and so forth. Notice the line here goes right to operating expenses, which this is under the income statement heading. Look at that. Look at your product cost. Notice everything that's inventoriable, you've got, if it's been sold, remember, if it's sold, it's cost of goods sold. If it's not sold, notice it's on the balance sheet until you sell it. And then again, it does go back to the income statement. Again, in this case, this is 2014. It's going to stay on here again until you sell it, and then once you've sold it, then it becomes cost of goods sold again. So again, know the basic differences between your product cost and your period cost, and essentially period costs are expensed right away versus your product cost, you only expense those when you sell them. Remember, if you don't sell them, they stay on the balance sheet as inventory. Now, if we're talking about product costs from a merchandiser, remember you'd probably use the account called purchases or just inventory from your financial accounting days. But the essential thing is think of all the costs necessary to get that product, in this case since it's a merchandiser, ready to sell. That could be the purchase price from the suppliers, again, anything else that you have to do to get it ready to sell, freight in if you have to pay the shipping, you know, taxes and duties and so forth as well. That all goes into the cost of your inventory. Again, if you're talking about a manufacturer, and again, I already set these up. Remember, there are 3 different types of product costs. Here you go. Number 1 is direct material. Number 2 is direct labor. Number 3 is your manufacturing overhead. And like I'd mentioned earlier, you see the word direct in the first 2. Those are direct. And again, think of those as easily traced to the cost object. So basically everything else, which is your indirect, is not easily traced. So again, I'm trying to keep this as simple as I know how. Not easily traced, that's going to be called overhead, manufacturing overhead. Now remember, the one thing about overhead is that overhead can make up a significant part of a product cost, and that's going to be our problem later on, specifically when we get into chapter 3 and so forth, when we look at job order costing and we get into process costing after that. But because overhead can be such a significant part of your cost, you have to have ways to track it. And because it is your indirect cost, notice not easily traced, and it's a significant part of your product, in most cases, lots of times the way manufacturing is these days, you have to have a way to deal with it. And that's going to be a big part of our problem this semester, is how to account for these manufacturing overhead costs, which again are all your indirect costs that relate to the product. Now, for just terminology reason, you may come across a couple of these terms. If they talk about what they call a prime cost, it's really easy to remember. Prime costs are direct material plus your direct labor. Conversion cost is basically your direct labor plus your overhead. So if you look at the 2 differences, you've got prime is all of your direct cost. Your conversion cost is your direct labor plus your overhead. You should know that, not just for terminology, but also to apply it. There'll be some problems later on, you'll see, where you have to be able to identify certain types of costs. They'll give you a list of cost categories, and they may say, give me the prime cost, or give me the total conversion cost. And as long as you can recognize these 2 categories and identify them, you should be able to get the calculation. So just a couple more examples of some direct versus indirect labor costs. Think of salaries and wages. Typically your salaries and wages would be considered most likely direct. But again, it really does depend on where that particular individual is working. Everything else, and of course, any sort of fringe benefits or payroll taxes, anything that's attached to the direct category of that particular individual is all considered direct. Now, if you've got salaries and wages for like the janitor or the maintenance people, and they're considered indirect, then all of their health benefits, fringe benefits, payroll taxes, all that would be attached to them, then all that would be the indirect cost. Okay, the next objective is to actually start to look at some financial statements. Mainly what we're going to be looking at in this chapter is we're going to be looking at the income statement and looking at how all of these types of income statements compare depending on the type of industry you are in. The easiest one, and you've seen this already from financial, so some of this is review. If you're talking about from a service company, it's really the easiest. You basically have all your revenue from services, all of your operating expenses, and this is going to be your operating income. Note, all costs are typically period costs because remember, there usually is no inventory types of items to deal with if you're service. Now there are some minor inventories like supplies and maybe some fixed assets, but for the most part you don't have any merchandise inventory. So most of your costs are going to be tied up usually in like salaries and advertising and so forth. So this is an easy one. Basically just take your revenue, subtract out all of your basic period expenses to get your net income. Now a merchandiser, it's a little bit more complicated because you do have inventory. So you should know this basic setup where you take sales, subtract out your cost of goods sold to get gross profit, and then you subtract out all of your operating expenses to get operating income. And I'll help you distinguish this right now. Think of your cost of goods sold is that's basically your product cost you're expensing. That's your inventory that you're going to be expensing. And think of then everything else, these operating expenses would then be what we call your period cost because those are basically your non-inventory items. So an easy way to distinguish in this category, always think of cost of goods sold as product cost, your inventory expense, and then all of your operating is going to be your period expense. Now this is again should be a review formula. In my class I simply call this cost of goods sold formula in my financial accounting, and the way you would figure out your cost of goods sold because you have inventory is what you started with, your beginning inventory. You add in basically all of your cost of inventory, which is your purchases, any sort of duties, tariffs, taxes, any sort of shipping. You get total cost available, and then you have to count at the end how much is left. The difference is called your cost of goods sold. Now let's contrast the merchandiser way of calculating some numbers, and let's go to manufacturing. Now remember, with your manufacturers, before we can actually get to cost of goods sold, remember we have those three product costs to deal with. All right, so we have these categories we have to go through, and I typically say in my classes, let's start first with your direct materials. So you have to figure out those costs. The second one is to get your, again, your direct labor. And then the third one is going to be basically to get your manufacturing overhead. Now, once you can get all of these three costs together, that's going to be your total inventory, your total product cost. But before we get there, we have all these steps. So the first step now is, in this case, this slide is showing you, well, how would you get just the first product cost, which is your direct materials? And that formula is right here. You take your beginning raw materials, you add in all of the costs, just like you did with merchandisers, all the costs to get those things ready to use. That's going to be your materials available. You subtract out the ending to get the direct materials used. Notice this isn't cost of goods sold. This is just one aspect of it. This is what you're actually using to produce those product costs. Now, remember, when you look at this, it looks very similar, if not identical, to the merchandising way of calculating cost of goods sold. So I like to call this an inventory formula to figure out what you're using, but this is just one step of your manufacturers. This is just the direct material part of it. Then you'd have to get direct labor, then you have to get overhead, and then once you get these three, we'll show you what you do with that. Once you get those three, then you're going to actually plug all these into another equation that's also very similar to this, then to get the cost of goods sold. So like I just said, so here's how you do it. So the basic idea would be, beginning work in process. The reason you start here is because you always want to see what were you working on, because that's going to be essentially the next step. So you basically take beginning work in process. Notice here's your three product costs. You've got direct material, direct labor overhead. You're adding these into beginning work in process. That gets what we call total cost to account for. You should know that, total cost to account for. You then subtract out ending work in process. That's going to be not cost of goods sold, but cost of goods manufactured. And that's also going to be referred to as what we call finished goods. Now, at the bottom here, let me show you another illustration. And I'm going to do this in a T account alignment, just to kind of give you another visual of this cost of goods manufactured. So think of, I'm going to write this out, think of you typically start with raw materials, and then you've got your work in process, and then you've got your finished goods. So these are your three different levels of inventory like we'd mentioned earlier. So the basic idea is you start building, so you need raw materials. Those raw materials then flow to WIP. And then once you're finished with it, then it goes to finished goods, and now it's ready to sell. Guys, that's what this cost of goods manufactured. The cost of goods manufactured is essentially at that stage, that is your finished goods. So what that should also then tell you about this work in process account, if you look at this formula, essentially the three things that go into work in process are essentially your three product costs. You've got your DM, direct material, your direct labor, and then your overhead. And then just think of this as your cost flow. Materials flow to work in process, flow to finished goods. What this formula is essentially doing, it's just showing you how to get the basic calculation, but you should also know the cost flow aspect of it as well. I think that will help give you a visual when you're working problems. Now, to carry over from the previous slide, remember we were at the finished goods part of it. This is once you've actually finished the product. It's basically sitting in the warehouse ready to sell. The next step is going to be your cost of goods sold. So finished goods then flows to cost of goods sold once you've sold it. This is your calculation on how to get that cost of goods sold number. So that's why they start with beginning finished goods. Notice they add in your cost of goods manufactured. That's just what you finished. That would equal all of your total available to sell. You subtract what's left in the warehouse. The difference then gives you this number, which is your cost of goods sold. And then, of course, this cost of goods sold is what is now on your income statement as your product cost. And so go back and remember your basic format where you take sales, you subtract out cost of goods sold, and of course that gives you your gross profit. This is how they get that gross profit number right here for the manufacturer. Okay, you'll notice on this example, they show you the long drawn out formula for cost of goods manufactured. And remember, I'm just going to identify your three product costs. You've got your direct material, plus your direct labor, plus your overhead, just to kind of keep it simple. You notice how they're adding all of these into some sort of beginning work in process number, and then we get your goods available. These costs right here, lots of times I like to call these or refer to these as cost added, because you're adding those to beginning WIP. Once you've added beginning work in process plus these costs, you get your total cost to account for. Even though they left that out on this particular example, you would want to add that title in. You take your beginning work in process, you add in all of your three product costs, cost added. Once you do that, they call it cost of goods available. That's also your total cost to account for as well, because you want to know your total cost in inventory. And then of course, look at the basic formula. You subtract out ending work in process to get your cost of goods manufactured. Remember that cost of goods manufactured, guys, that is your finished goods. That's the number that goes to the finished goods part of it. And then down here, they're just giving you some examples of what the overhead would have represented. So generally speaking, again, overhead is going to be the tough one later on, is to identify what is overhead versus what's not overhead. And then you'll notice how to get to the cost of goods sold for your manufacturer. You start with beginning finished goods. This is what you just added. Your for short, I refer to that as COGM, cost of goods manufactured, total available for sale. You subtract out the ending finished goods, and then here's your cost of goods sold. That then goes to your income statement for your product cost expense. And again, I said this earlier, but just to reinforce it, again, here's your sales, cost of goods sold. If you just refer to the previous slide on how to get that, you get gross profit and then operating expenses, and then of course your net income. So remember, just to remind you, cost of goods sold is your product cost, whereas your operating expenses, that's going to be everything else. That's going to be your period cost. So hopefully that'll be an easy way to distinguish the two, easier to remember. Product costs are always in the cost of goods sold category. Your period costs are always going to be considered just your operating expenses. Remember, those are expensed as incurred. Now, I had mentioned this before, but I'm going to walk you through it again. And think of, again, when you're looking at a manufacturer, you've got those three different types of inventory accounts. Typically, your first step is your raw materials, and I'm going to give you the whole visual here, and then we'll go to the next couple slides. But basically, where we're headed with this is you start with your raw materials, you then go to work in process, which at that point, once you're finished with it, then you go to finished goods. And again, I like the T account setup because you may have to do some journal entries later on, so debits and credits still come into play. But this is just showing you all the different, they're trying to show you the cost flow aspect of it right here. So you start with in the beginning, you add purchases, anything that you start to use, again, you're going to credit inventory. That's why they say materials used in work in process. That's going to be the amount that's going to be transferred there to the work in process. And then, of course, once it all gets grouped into work in process, once you're finished with it, then it gets to finished goods. And then I'm going to draw one more up here just to kind of keep this on one slide. Once it's in finished goods, it stays there until you sell it. Once you sell it, it becomes cost of goods sold. So remember, raw materials, work in process, finished goods, all on the balance sheet. That cost stays there until you sell it, and then it becomes cost of goods sold. So like I said earlier, here's your work in process account. So I'm going to label this by our three big product costs. So number one, think of this as your direct material. Here's number two, there's your direct labor. And then number three, there's your manufacturing overhead. These are all of your cost added. You're adding these into work in process. It stays here until you finished it. Notice it says cost of goods manufactured and then sent to finished goods. You'll actually credit work in process whenever you finish it, and then of course you're going to transfer it into the next T account or the next ledger account called finished goods. And so here's the finished goods inventory. Notice beginning inventory. Here's what you're transferring in from WIP. Here's your cost of goods manufactured. And of course, once you've sold it, it's going to be transferred over to your cost of goods sold T account. It's going to go out of finished goods as a credit. It's then going to be debited to cost of goods sold. And that's going to go on your income statement as your expense. Okay, so you got to remember a couple more things to talk about in chapter 2 is remember in managerial accounting we're focusing a lot on the decision making internally inside the company. And so if you are a manager, an accounting manager, there's what they call controllable versus uncontrollable costs. You have to know what you can manage versus what's not manageable. And so a controllable cost is something that you can actually influence the cost making part of it, whether it's to go out and do more advertising or non-advertising or to hire more employees or whatever. But if you can affect the cost, then they call that a controllable cost. If it's a cost that's going to basically be there no matter what, I often refer to these as sunk costs. In other words, you cannot affect it. You can't, it's not, the outcomes are not going to change whatsoever. We tend to call these uncontrollable. And again, the reason you want to know the differences between these two is think of in terms of relevancy. If a cost is controllable, you would say it's going to be relevant for decision making. If it's not controllable, it's going to be not relevant, because remember, if it's something you can't deal with, if it's not going to change your influence your decision making, then it's something that you essentially are going to have to ignore. So again, relevant cost, just some terminology things coming up a little bit later, not so much in this, but in future chapters. If they say something's relevant, they like to say it's going to be also called a differential. Sometimes I call these marginal types of cost. Again, those are also your relevant cost. Irrelevant, again, it does not matter. Again, I like sunk cost the best. You've incurred it, you can't change it. Costs that do not differ between alternatives. It does, again, you can't control these. Those are basically your irrelevant types of costs. So again, relevant, again, think of those, again, those are somewhat controllable. Irrelevant cost, again, are not controllable. Okay, the last couple things we'll talk about is what's called fixed and variable. Now, we're going to spend a lot more time on this later on, but in this particular chapter, we're just going to talk about the basics of what they call a fixed cost or a variable cost, and how to calculate these total costs, because this is all about making predictions about future cost, which is also a part of the decision-making process. So just keeping it simple in this particular chapter, we will discuss these a lot more later on in detail. Think of variable cost as costs that change with volume. Okay, cost of goods sold would be a variable cost. The more you sell, the more you're going to have in terms of cost. Okay, cost of goods sold goes up and down versus sales. All right, direct labor would also be a variable cost. The more you produce, the more you have to pay. A fixed cost is a cost that basically does not change. Kind of like your rent, but you have to look at time periods, because really everything does change. But a basic fixed cost could be such as rent or a salary. It's fixed for a time period for 6 months, it's fixed for 12 months, it stays constant. And it's important to know these two different types of cost, all about decision making and planning. If some costs are going to be the same no matter what, lots of times fixed costs are sometimes put into this category of not relevant, because you can't change them. If you can't, then they're not controllable. But the variable costs are the ones that really concern companies, because if volume of production goes up, their total costs go up. And that's something that companies try to avoid or eliminate, is companies are always looking at ways to reduce cost. So for example, a sales commission, total, your sales commissions would be variable. The more you sell, the more you're going to pay your salespeople. Notice in this particular graph how as sales go up, if sales commissions are 5% on all sales, notice how this is going to be an upward trend. Okay, so volume goes up, so does your cost. That's a good example of a variable cost. So again, a fixed cost is a cost that's going to be flat. Notice in this case, as sales are going up, see how you just have this flat line? This could be a rent cost or whatever. It doesn't change. So as your volume goes up, this cost is flat. That's called a fixed cost. This is the type of cost that if companies are going to incur, this is what they want to see. They like costs to behave as fixed rather than variable, because they're much more easier to predict and also to control. So if you look at this little formula on how to get the total cost, you add up all your total fixed cost, and then you take your variable cost, what they say cost per unit, times the number of units. It could be a raw material cost, it could be labor per hour, or whatever. So in this particular example, they say if your total fixed costs are 20 and your variable costs are $50 per unit, remember your variable, it changes with volume. To figure out your total cost is you just simply take your fixed cost plus 50 times 100, or there's your 5,000. That's how you can predict your total cost of 25,000. Now another way, and this is kind of like the quick and dirty way of doing it, but I wouldn't necessarily say it's the best way, is if you just want to get a total cost of all of your units. Pretty simple. If you paid 25,000 bucks and you had 100 units, the average cost is $250 per unit. But remember, the big thing here is you can't just say that that's going to be your total cost for everything, because this is only for one specific level of activity. So it's not, again, not appropriate for different levels of activity. If levels of activity change, this cost per unit is also going to change. So for marginal cost, just know the basic idea at this point. Definition-wise, you don't really have to do much with it yet, but the marginal cost is how much it costs to make one more unit of your product. And remember, that would be a relevant or also a controllable cost.